If you're not seeing consistent results in your investing, you're likely making one fatal mistake that's killing your portfolio's returns. So in this video, you're gonna learn what that is and how to fix it fast. This comes from the Stock Investor Accelerator, where we develop investors and teach them a process to grow their investment accounts and generate better returns at their firms. The number one frustration that I hear from new investors goes something like this. You do the research, you find a great company, and you buy the stock, but it still loses money. You see, in 2025, a company like Palantir can report record earnings and the stock rips up 30%, then drops 30%. You can do everything right, research the fundamentals, even buy with a great earnings report, but you still lose. So what's going on? It's tough enough to find a great company, but can you even make money picking stocks? When I first started out, this happened to me all the time. Like in 2018, I invested in this aluminum company, Alcoa. Why? Because aluminum prices were rising. China was cutting back production, which should support higher commodity prices, and the company had just reported great earnings. So I bought the stock and I lost 20% in a few months. If I had known this one simple principle back then, I could have made money. So to explain, let's use the 2021 to 2022 market period as a case study. So markets went up to all-time highs and then they dropped the following year. The total return of the S&P 500 was just 2%. So this was a stock picker's market. You had to pick the winners and losers to really generate returns. Now, normally you might think a company that's growing its earnings or its profits should do well. I should buy the stock because higher earnings leads to a higher stock price, right? Well, let's start with a 20K account. And let's say we invest and look for companies with great earnings growth. We look around and decide to invest in Adobe, Chipotle, and Nike in 2021. So these are all well-known leading businesses, and all of them were doing really well at the time. Adobe was your stable growth stock. Investors are buying it for the growth in document and creative software like Acrobat and Photoshop, and it was the go-to platform for creative professionals. Nike was the digital growth story. Investors were jumping on the company because of the successful pivot to e-commerce, and earnings were rebounding pretty hard after the pandemic. Chipotle was this new up-and-coming growth company. They were leading this fast casual restaurant concept, and earnings were doing really well as people were starting to eat outside again post the pandemic. So all three of these companies are showing a history of great earnings growth, and they were great companies. So here's the final scorecard of these investments over that time period. Something interesting happened. We invested in great companies with great earnings, but we lost money on most of these stocks. None of them's outperformed the S&P 500's 2% return. Like, what the hell? So now let's try something else. This time we look for great companies, but now we're going to start buying where the investor expectations are low. So we look around and we decide to invest in ExxonMobil, NVIDIA, and Kroger. So these are all well-known companies. Kroger, by the way, is a large grocery chain in the US. But the key difference is investors really didn't expect much from these companies. ExxonMobil was an oil company. It's just left for dead. No one wanted to invest in oil companies, especially after prices went negative in 2020. But we noticed that the oil market had rebalanced. Prices were $65 a barrel, and ExxonMobil was already making profits by early 2021. NVIDIA was a growth company that was just abandoned by investors in 2022. So demand for crypto mining faded, semiconductor prices were down, and growth slowed and then declined a little bit through 2022. But we saw that the data center business of NVIDIA was growing, and a lot of these pressures on prices were likely just temporary because there was some short-term production coming into the market. Now, Kroger was expected to be a post-pandemic loser. So investors expected grocery sales to decline because consumers are going to start eating out again. So sales growth did decline slightly in early 2021, but we knew that they had a digital sales strategy that was driving grocery sales, and really we believed in the long-term growth story, despite some of this near-term pressure from the pandemic ending. So all three are solid companies, just facing some temporary headwinds. So here's a final scorecard of these investments over that period. Funny thing is, these stocks generated amazing returns. All of them outperformed the S&P 500's 2% by a huge margin. And this doesn't even capture the NVIDIA's outperformance, right? The recovery for NVIDIA started in late 2022 and continued well through 2024 and 2025. But that recovery in 2022 was still enough to generate positive returns. So what's the key difference with these picks? Well, this time we looked for low investor expectations. You can see in the table that the actual earnings per share, or EPS, of these companies turned out to be a lot higher than the analyst estimates. So we're still using the same fundamental approach. using research to look for strong companies with a great long-term earnings outlook. But we take a slightly contrarian approach by buying stocks where the expectations are low. And when we do that, our returns are much better. So the key to outperforming the market with your stock picks is you have to understand the expectations in a stock as well as the business. In equity research, we were always asking ourselves, what is priced into the stock? So for the first group, Adobe, Nike, Chipotle, they all had great earnings. But the problem was the stocks had very high expectations. If you notice the analyst estimates during that period, the estimates for earnings per share, or EPS, were much higher than what they actually reported. Plus, the price to earnings, or PE ratios, were very high, so the valuations are very elevated. Analysts would sometimes call these stocks priced to perfection. So all it took was a whiff of some kind of weakness, and these stocks collapsed. So what happened was Adobe's growth slowed a little bit in 2021, from 22 to 11%. And its earnings guidance was lower than what analysts expected. So that was just not fast enough to justify a 47 times multiple. So that stock tanked. Chipotle got hit with inflation. Food costs rose, took down the margins, and earnings just missed analyst forecasts. So that's what sparked the stock's correction, wiping out most of the gains from the prior year. Now, Nike faced a perfect storm in 2022. Too much inventory, had decline in China's sales, and a cost inflation. So earnings grew, but just barely, also below analyst estimates. So that 38 multiple was just way too high, and that's why the stock sold off. So these stocks fell much more than the actual business earnings weakness because the performance fell short of investor expectations. You can think of it like high expectations, small miss, big stock drop. That's why they dropped so much. Now, what about the low expectation stocks? Well, all it took was some kind of recovery or just growing earnings, and these stocks really took off. So ExxonMobil basically doubled its earnings between that period because oil prices held steady. They rose a little bit, so that boosted sales. When combined with the cost cuts, drove pretty strong earnings growth for the company. NVIDIA took a hit in its earnings in 2022 with the lower semiconductor prices, but then OpenAI launched ChatGPT later that year, which kickstarted the wave of AI spending that accelerated that growth of the data center business. Kroger just grew steadily in 2021, despite fears of fewer grocery buyers. Plus, in 2022, when inflation hit, shoppers did start to go back to grocery stores. Prices went up, so all of that just helped grow its earnings. So think of it like low expectation plus improvement equals big stock increase. The businesses all performed well, but more importantly, they performed better than expected. And that's why the low expectation stocks went up so much. So how do you check expectations? Well, there's two simple ways. First, you can look at the analyst estimates. So if the growth estimate is low for the company, especially after some kind of short-term weakness, well, that's a clear sign of low expectations. Examples of low estimates include Kroger in 2021 and NVIDIA in 2022. And so you can see that was a signal that probably there was a good time to buy, assuming the decline is temporary. Now, second, you can look at valuations. If the stock's PE multiple has come down to below its historical range or below its peers, that's low valuation is a sign that investors have abandoned the stock. So example of low PEs are ExxonMobil or Kroger in 2021 and 2022, and both signaled an opportunity to buy, again, assuming if that weakness is temporary. But this doesn't only mean that you need to buy cheap or beaten down stocks to outperform. In equity research, I recommended my clients buy MSCI at a pretty lofty 48 times PE multiple because I saw the market was not recognizing its new business in sustainability investing. The estimates were too low in my view, so I recommended clients buy it. Once the sustainability business took off, well, growth accelerated for MSCI and the stock revalued at a high price. MSCI stock rose 70% between 2020 and 2022. So here's a tip that I learned from equity research. Whenever I'd pitch an idea, salespeople and hedge funds would always ask me, what is your upside to your estimates? Now, at first, I found that pretty annoying, but I realized over time that was useful because that's how I pitched MSCI. You can train yourself to think that way. After you read a company report, ask yourself, are the analyst estimates, are they too high or are they too low for the company's earnings? Now, if you notice they are, well, you may have just found yourself an opportunity and a potentially mispriced stock. So that's the one thing that you're likely missing in your stock picking. It's expectations. The key to outperformance is to find a great company, but then you want to buy low expectations. That's how you make money, especially in a volatile market. So someone once asked Warren Buffett, what's the secret to life? You know what he said? Low expectations. So next steps for you is we have a free masterclass on picking stocks using fundamentals and strategies to find great companies and stocks that are mispriced. You can register for free in the description. And thanks for watching. And remember, great company, low expectations. That's the key.